Hey everybody. I think I just said hey everybody instead of hey everyone and hey everybody. Well, it's that kind of day here, lazy Friday afternoon. Let's go over this homework. Okay, everybody. It's Steve. Hey, let's go over a little bit about inventory, which is what this chapter 10 for accounting 110 is all about. Here we're talking about the accounting of inventory, and it's really important that we talk about the fact that we're just talking about the accounting of it, because we're going on the assumption that our prices are going to be remaining stable, but that our costs are going to be going up and down. And when we say, like, we'll get to talk about first in, first out, last in, first out, and weighted average here in a second, but we're not talking about the actual physical goods. Like if someone in the warehouse accidentally took, if we're using a first in, first out system, and someone actually accidentally took an item from the front of the stack, that doesn't throw anything off. It's not about the physical inventory itself as it gets filtered through our business. It's about how we cost it out as a business. Because if we have static prices or stable prices and different inventory costs for us, cost of goods sold, that's going to affect our revenue. We're going to make more or less money depending on how much our own costs were. So that's sort of the backdrop of what we're doing here for all of these problems. And so the first one here we look at is problem set A. Here we look at problem 1. And the math here, is going to be really not that complicated. What is the important part is which numbers to use and know how you're costing that out. And so here we have, in this first one, we have 3 different transactions, right? Somebody bought some stuff, right? Bought some stuff from us, and we are looking at how much gross margin we're getting for each product sold. And gross margin is revenue minus cost of goods sold. So let's pop over then to our working papers. And instead of doing the math for the actual problem, I've just kind of set up a little example problem for company X. And company X sells a product that they sell for $20. And their prices here are going to remain stable because let's just say this is sales prices go up and down. But in this case, we're using a stable price. And so I have, where the book has 3 transactions, I've got 4 here. And here, when the company purchased these 5 units, they paid $10 in COGS, sold them for 20. So your gross margin would be 10, right? It's 100% markup, and you're making $10 because your cost was $10. Here we have 7 units that were $11, sold for 20, so our gross margin is $9, right? Because our costs were up here. Let's say something happens, we have our costs go down a little bit, and we have $9 for our own cost, or our cost of goods sold. So we're going to make $11 of profit for each one. And then, here in the last example here, I had 8, and for some reason our costs went way up. We still sell them for 20, and we're only making $5 per, right? And so that's what we think about. That's kept up. We think about raising our prices, but that's neither here nor there. We're not worried about that yet. We're just looking at how much of a profit we would make in each of these situations. And that's what the first problem is really about. And so if you are using, and we'll get down here to weighted average in a second, if you're using the first in, first out method of inventory costing, when we have this total of 20, we have 29 items here. Just put here, we have 29 total items. So I'm in VMware because it doesn't do number lock. Okay, so we have these 29 items, right? And again, it doesn't matter how they're sold out of the factory, it's how we're going to be, or excuse me, out of the warehouse, is how we're going to be costing them. And so if we say, if we do the typical entry for a sale, right? So we have, let's say that people pay cash, so we're going to get cash. And sales, and we're also going to have our cost of goods sold and our call it merchandise inventory. I'm just going to call it merch. Okay, and so, we're just kind of looking at like how much we're going to make based on which of these costs we're going to be costing out, which of these inventory costs. So if we have, let's say we have purchased these 29 items and then we have a sale, if we're using first in, first out, the first 5 units that we sell, we're going to cost at $10 each, because we're using first in, first out. These were the first ones that, these are in chronological order, so the first ones we got. So in that case, we would have let's just say that they bought 3 of them, right? They bought 3 of these items from us. Their sale price is $20. So it's going to be $60 and $60. This is just a real, go ahead and put debit and credit there too. And so we have our debit of 60, we have our sales of 60. Our cost of goods sold in this case would be $10. And $10, because again, if we're just using 3 items, we don't ever go out of this for first 5 units purchased. So when we're talking about these problems, it really is just thinking about which items of our inventory are we costing out. And so if we had a situation where it was, 7 items, it would be these first 5 and then 2 of these, so that our cost for 5 of the items would be 10, for 2 of the items would be 11, right? And so it's just really, it is about accounting wise, which items are left. So if we bring this back to the problem for problem 1, if we're using first in and first out, we put the sales revenue here, our cost of goods sold, and this is based on the numbers from the problem, but I'm just again doing the example here, is that for this case, we would have put for sales revenue $60. Our cost of goods sold would have been, 10, it would have been 30 because we sold 3 of them, my apologies. It would have been 30 here, and so our gross margin would be 30, right? Let's say we did a last in, first out. So in that case, let's just say we still sell 3 of them, so we're going to just put 3 as a reminder. Down here is where we're going to have our this is where that inventory comes from, because these are the last in. Again, this is chronological. So of these 29, the last in were this batch that were sold, that we purchased at $15. So you're going to go over here, and instead of a $30 cost of goods sold, you're going to have a $45 cost of goods sold. And so in that case, we go 60, 30, and we make $30 in gross margin here. Here, not making it, making less. So our sales revenue is still going to be 60 because we're still selling at $20. Our cost of goods sold, however, is going to be 45 because we purchased it for 15. That gives us a gross margin of 15. It cuts our profit in half. And so again, this is where we'll be thinking about raising prices. For the final one, we're going to be talking about weighted average. Let me go ahead and clear that out. And so again, you're using the prices from here in the actual problem here. I'm just giving you this example. To figure out weighted average, what you do is you find out through multiplication, you have this number of units, this many dollars. So 5 units at $10, that's $50. 7 and 11 is 77, and on and on. You calculate that out. So we've got our 50, our 77, our 91, and our 120, and those were the total costs for each total order, right? And then we add those up, and that gave us a total of $328. We've spent, again, if this is a month, let's say this is a month. Let's say this month we have purchased $328 in total in inventory. And that constitutes 29 units of inventory, right? Add those up, it's 29. So then you divide the 29, or you divide the 328 by 29, and you get the average cost, and that is the weighted average. And so in this case, then, our weighted average, where we were using the cost up here, the weighted average looks at the entirety of the units and just, again, does an average of all of them. So in that case, Our sales revenue, again, if we sold 3 products, our sales revenue doesn't change, $60 every time. But in this case, we would do, see what this is, $11.31 times 3. And then our cost of goods here would be $33.93, our merchandise inventory, $33.93, and our gross margin using weighted average would be 60 minus 33.93, which is going to be, I think, $16 and something. So you can see here how you do those calculations. And so that's sort of the setup for all of this. It's looking at what we have in inventory, how much it costs, and using the different types of inventory costing, calculating the numbers and putting them in where they need to be. So I'm going to pause the video here for a second and set up the second problem. Okay, so we're just going to look at the problem here for the second one, and we'll talk about how you do it. So for each of these, let's take a look and see what's on our screen. We have a company, and they have had, they had a beginning inventory of this amount. So they started looks like for the month, so they started the month with this many items. They ended the month with 900, and over the course of the month, they had purchased a total of 4,570 items. And the total just cost right here, they can use that later. And so it's then calculating the ending inventory for each of the cost allocation methods using periodic inventory updating. And so this is very similar to the first problem in that we're just finding out in that ending inventory, right? How much cost per unit does that ending inventory have, and what is that value? And it is, again, based on which type of costing we use. So if we say that we have, and we have these 1, 2, 3, we had a beginning inventory, and we had 3 purchases along the way, so we have 4 total purchases. And we have an ending inventory of 900. What we have to think about is if we're doing first in, first out, the first sales are going to come from that inventory that we brought in because they were there first. Then we're going to sell these, we're going to sell these. And so when we get down to 900, we know that they're part of this since the first in, first out are out. They've been sold. The ones that have left behind are from our last purchase because the other ones have been sold, right? And so if we're talking about last in, first out, we're going to start selling from this pile, then this pile, then this pile. And so if we say that we have 900 units, it's all going to be in this beginning inventory because this is, we don't go above 1050. If we were above 1050, they'd be part of both piles. But again, they're going out last in, first out. So this was the last in, it's the first that's going to go out, gone. Boom. This one's the next out, it's going to be gone, and gone. And then, 900, so you're going to have 150 of these gone too, but you still have 900 left, and it's the beginning inventory right here. I hope my mouse is showing it on screen, because if not, I was just talking, but then you wouldn't see the pointing, but let's hope that's right. Please tell me if it doesn't. I'll change how I do the video. Okay, now I'm going to pause it and go back and set up the next problem. Okay, so the next problem, we're using first in, first out inventory allocation or cost allocation. We have some purchases of inventory and we have some sales. And for each of these, we want to do the journal entries for the transactions. We are assuming no beginning inventory, so we don't have anything, we're not adding to anything, we're starting from scratch. And that is going to look similar to the example I had in problem 1, where we're going to have, when we have sales, they will look like this, and when we have purchases, they will look like a typical inventory purchase, right? So like, let's just say if we had, let's bring over that example. So, let's just say that for company X here, we're not going to use excuse me, here are those unit costs, which we will use, but or that you will use in the problem, but here in this example, we won't use that, right? We'll use these. And so in this case, if we want to reflect this, the purchase of these goods, then it would have simply been it doesn't say whether we purchase this on our inventory with an accounts payable or cash. Go ahead and put accounts payable. It's more typical. Cash would be right, but you can, but just go ahead and put accounts payable. And then so like say for this particular instance, we had those 5 units at $10, and so the debit would have been $50 and $50, right? So that was just, and so for all of these, that would be the same entry, right? So you purchase merchandise inventory, you know, $77, accounts payable or cash, accounts payable, 77. That would be the purchase for all of them, if that's all we had. But we also have, in the next problem, we have some sales as well. And that's where those are going to kind of look like these. So you're going to have cash and sales, and you're going to have cost of goods sold and merchandise inventory. Now, you don't have to do a lot of different calculations in this one because it tells us up front that we're doing first in, first out. So you don't have to, like, you know, we don't have to calculate it for FIFO, then LIFO, then weighted average. We're just using FIFO. So in this case, we know, let's say that we sold in our first transaction, because this will come up in the problem. Let's say that we sold, you know, some from one batch and some from another batch, right? Let's say in this case we sold 7. So we sold 7 items. Let's say 7 items here, just as a reminder. And so that in that case, we would have people bought cash, whatever. We'd have cash and we'd have sales. Now again, because our company here in this example company, we don't change our price, it's all $20. All 7 of those were $20, so we're getting $140 cash. Question then becomes, how do we do our cost of goods sold? And the thing is, you just calculate both prices in the calculation. So what you do is you say, well, we had 5 units at $10 a piece, and we had 2 units at $11 a piece, and you calculate that out. So here we have our $50, and here we have $22. Just doing the math in my head. And so our cost of goods sold would be $77, because you'd add those two together, because you're using, again, you're using parts of 2 different orders. You're using parts of 2 different inventory orders to fulfill the customer order. So, you know, it's going to be all, again, first in, first out. So it's going to be all 5 of these, and then 2 of these. And the remaining inventory would be 5 of those, right? And so in that case, you would go in here then and put, just going to pause, and then just going to put MI, that's inventory. You should write out merchandise inventory. Don't be lazy like me. Okay, 77 and 77. And that's how you do the third problem here, problem 8. You're just going through, as we go through here, is that you have, looks like you have 3 different purchases and you have 2 selling transactions. So, you know, you're not even going to worry about these because they're purchased after both of your sales. But I will say in the second sale, you are going to be dealing with 2 different inventory costs. And in that case, you just take however many were at that cost, calculate them out. However many were at the second cost, calculate it out, add those 2 together, you're good to go. Now I'm going to pause it and set up the fourth one. Okay, so the fourth problem is just more of a kind of an in-depth charting out of the stuff we've already done. In the problem, we'll pop over to it right quick. It's another one where we are, this is number 9, correct? All right, yes, number 9. And we're using FIFO, tells us what we're doing, so we don't have to worry about that. We don't have to worry about doing multiple calculations. We're just using FIFO. But we want the cost of goods sold, ending inventory, and gross margin for this company called A76. And then it is just all about bringing these numbers, the ones that are in the problem, over to the spreadsheet. And here I'll do the first one because it's easy and it will show you how it's done, right? So, and also I have little, 3 dots where you need to be putting stuff. So that's another little hint there. So if we say our beginning inventory, do we have beginning inventory? That's your first question. If you didn't have any, 0, 0, 0, right? Because there wouldn't be it. But let's go back and check. Here in this case, we do have a beginning inventory. We have 240 units at a unit cost of $100. Okay, so I've already forgotten, I believe, but unit cost was $100. Remember that. I think it was 140 units, but let's go back and look. 240 units, I'm glad I looked. Okay, so we have 240 units at $100 at a total cost of 240 times 100 or $24,000. Right, and that's how you do it for each of these. So then you're going to be doing a sale. It's a FIFO. Keep in mind, we're doing a FIFO cost allocation. Couldn't think of it for a second. And so they're going to sell 160 items. Those 160 items are coming out of this total. So sell 160 of them, and then what's left, you will subtract however much you sell, then you'll know how many units you have left. We sold 200 units here, 200, $100, $20,000, and then we would have 40 units, 100, $4,000, right? And then we would do a purchase. And so this is going to change up our unit costs a little bit, right? If it does change it up, but yes, it does change up our unit costs a little bit. So that total cost is going to change. You're going to want to add whatever you got here to the purchase, right? And here you have a sale, so you're going to be using through two different batches, and then you're going to, again, you're going to do the math here. You're selling it, so you're going to subtract. And you go down the line and you find your total purchases, total cost of goods sold. There they are. There they are. Add those up. Go get your total sales, subtract your total cost of goods sold, get your gross margin. Pat on the back, you're done. And that kind of covers all of the problems. Keep in mind, again, we're just don't get caught up in the actual physical inventory. We're just talking about like the costing, sort of a theoretical price or a theoretical item. And then again, the math is not super hard. It's add, subtract, and multiply, a little bit of division, but it's figuring out what to use in these cases. As always, if you have any problems, just send me a message on Canvas. Or come by the virtual media lab. I would love to talk to you if you have an issue. Otherwise, have a good one. Goodbye.